Hey guys, it's Cameron here with Emerson House Buyers. Every week I bring you tools, tactics, strategies, lessons I've learned, things that have helped me build up a sizable rental portfolio in only about 2 years. Today I want to field a question from Mr. David. David, I appreciate your question. And he had questions regarding the BRRRR strategy. For those of you who are not familiar with BRRRR, it's buy, rehab, rent, refinance, repeat. So it's a way, if you're trying to buy a lot of rental properties, this is exactly the strategy that I used to build up my portfolio. It's the only way, really, unless you have bukus of money, to continually buy rental properties because you're basically getting paid to close. All right, now you have to find good deals, and I'm going to walk you guys through an example here of the BRRRR strategy. I've got an older video of one that we used in the BRRRR strategy, so you can check that out. But I want to redo this, make sure we're answering these questions, make sure it's clear on what the BRRRR strategy is, and how you guys can use it to grow a substantial portfolio, and how I used it to scale up and buy a couple dozen properties in only a few years. So, first and foremost, you have to find a good deal. If you guys want some tips on marketing, you guys can check it out up here on how we market and see how to find these deals, because that's the most critical piece. What I'm going to show you is the math behind it, but the most critical piece is really finding a good deal. That is where this starts. So I'm assuming that you've already found a good deal. So let's look through these numbers. So purchase price. We purchased this property at $96,200. Can you guys see that? Purchase price $96,200. We had repairs of $13,000. We had closing costs on both sides of totaling $5,000. Now I'm just bear with me if you don't know where we're at. Just bear with me. I'm gonna write these down. The ARV, the after repair value, was $160. And that means we got a loan at $128,000. And our cash back was $23,600 or $5,600 after, or $5,600 net, which is $23,600 minus $18,000. Okay. Now, I've got all my numbers here. Okay, put it all down. First things first. Again, we said you want to find a property. What you want to do, you want to find a discounted property. So, we're buying this property, purchase price at $96,200, right? The rehab is $13,000, right? We're about all in at 110, just about. Now, the ARV on the property is $160,000. Closing costs were about $5,000. Guys, this is a good. It rented at the time at $1,375, and I just want to emphasize the deal has to be good. The first purchase, the way you actually purchase this $96,200 is you can use private money, hard money, money from your own pocket, a home equity line of credit, family, friend, whatever. You can use money from any source. The trick, what the BRRRR process was really created for, is this next piece, the refinance piece, right? So purchase, repairs, you're all in at about 110, 115 with closing costs. That's on both sides. ARV is 160. I go out, so bear with me one second. You're all in at 110. We'll just say 115 with these three, right? Purchase, repairs, closing, you're all in at about 115. Okay? Your ARV is 160, and your loan, we go to the bank, and the loan is 80% of this. So we fixed it up, we put all that money into it. The bank comes out and appraises it at $160,000. They tell us we will give you 80% of that $160,000, which is $128,000. If you guys don't believe me on this deal, these numbers, I've got the closing documents to prove it. These, so they'll give us $128,000. Again, after closing costs and what have you, we walked away with $23,600. Okay. Once you take away, so that's what the check we got. We got a $23,000 check at closing the second time. Okay. After you take $23,600, subtract the $18,000, which is the repairs and closing costs. And closing costs are points on your loan. If you got, the interest payments you're going to make, all that stuff. It was about $5,000 total. So 23,600 minus 18 left us with $5,600 net. So we actually made $5,600 after we did this, right? Found a property that was undervalued. We purchased it at $96,200, put all this money into it. It appraised at $160. We went to a traditional bank. I highly, highly, highly recommend credit unions. Highly recommend credit unions. Went to the local credit union, got a loan for $128,000. The $128,000 paid off this $96,000, right? That from our first loan. So we basically took this money, paid them off, paid our closing costs and repairs, and walked away with $5,600, right? And on the closing document, on your final refinance, they will automatically, you just tell them, here's the primary lien holder or the first lender, and here's what the balance is. And they'll tell you what the balance is, and that will dictate your $23,000, right? So 128 minus the 96 and all the other closing costs and everything, that's what we walked away with is 23. And that has prorated taxes, insurance, everything out of it. That's what we actually walked away with. But that at closing. But we also had the closing on the front end and the repairs that we paid out of our pocket to get our $5,600 net. So guys, we purchased this property and walked away with, after everything's said and done. Now, don't get me wrong. It's not like we just walked in there, slapped some paint on something and walked out and walked away with $5,600. We had a relationship with a private money lender who closed when we wanted to close. We had a relationship with a bank, a credit union specifically, that trusted us, that wanted to refinance this, that came in, appraised it at $160, gave us a loan at $128, and allowed us to pay off all these expenses that we had and walk away with $5,600 and a great rental property. I think the loan on the interest on this was like 3.5, 3.75 as well. So it was a great loan. If that answers all your questions, Mr. David, let me know. If it doesn't, please let me know, because this is one of the most powerful strategies in real estate, in my opinion. I don't care what anybody else says. I do not know a better way to buy a lot of houses, and not even that you have to go quantity over quality, but there is no better way to use this to grow your real estate portfolio. I would not have the portfolio I have today if it wasn't for this strategy. If I just had to put out $20,000, $30,000 every time I wanted to buy a property, I would not be able to do this. It's me getting my capital back, and then some in this case, and being able to pile that in the next property. And doing that over and over. And yeah, this is a great example where we walked away with money. There's some where we walked away with $15,000 or $20,000 too. But the thing is, even if you walk away and only spent $5,000 or $2,000 or $10,000, that's such a great return. And you're making, this property makes today about $200 to $250 net after everything's CapEx and all that. I think it makes about $200 to $250 a month. So do the math on that. The return's infinity. Even if we had to spend $500, $600, you're making $2,000. That's $2,400 a year. Those returns are unbelievable. So that is something that you guys need to think about with this strategy. Is even if it's not perfect where you walk away with money in your pocket and you have to spend a little bit, by spending that little bit, you boost your return on investment or ROI significantly. So if that was helpful, David, let me know. If it wasn't, let me know. If you still have questions, comment below, shoot me an email. Let me know how I can help, because guys, this is a very, very powerful strategy I think everybody should understand. Thanks, guys. See you next week.